Hey everyone, in this video I'm going to discuss why ChargePoint is one stock I'm staying away from and all of the reasons why ChargePoint is in a difficult financial position. So I'll share with you its latest quarterly results, and then I'll share with you its longer term struggles, and finally look at the valuation to justify the reason why I'm staying away from ChargePoint stock. So let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so ChargePoint has been one of the stocks that I've had rated as a sell for some time. I last updated that recommendation to sell ChargePoint stock on April 22nd, and there are a lot of reasons why I'm avoiding this stock. Number one, the company's revenue is in decline. Let me share that with you. First quarter revenue was down 18% year over year to 107 million. Now, this is a charging company, right? It's doing charging solutions for electric vehicles. This is supposedly a growth industry, the next generation of vehicle technology, but it's not growing. It's not growing because it's not highly in demand. Consumers are more often than not, 9 out of 10, more than 9 out of 10 consumers are choosing internal combustion engine vehicles in the US. And that's despite the trillions of dollars of government stimulus trying to encourage the growth of electric vehicles. Imagine without any of that government stimulus, that government incentive, those government mandates, where would demand be for electric vehicles? That organic demand for electric vehicles is tiny, just a tiny sliver of the market that electric vehicles make sense for. And the government is trying to encourage more, but it's just not there yet. The technology is not there yet. They need faster charging, more convenient charging, and before that happens, this technology is unlikely to generate sufficient demand. Or it's got to come at such lower prices where people feel like it's a prudent financial decision because it's going to save them money. Right now, it's more inconvenient and it costs more. So for the majority of people, it doesn't make sense. This company, at its current scale, is losing significant sums of money on the bottom line. The gross profit margin fell to 22% compared to 23% last year. They are trying to bring down costs as quickly as they can, but even after cutting costs by 18%, their operating expense came in at 90.7 million. And so that led to a loss on the bottom line of 71.8 million. Now that was an improvement from a loss of 79.4 million in the same quarter the prior year. But they're not making improvements quickly enough. Their cash on the balance sheet was 292 million. So you could look at this and see, okay, 71.2 million in losses, and they have 292 million in cash. That's about 4 or 5 quarters of runway for this company. So it's going to lead more cost cutting necessary. And when you're cutting costs, they're cutting costs in areas like research and development. So the future is looking less bright for this company as others are innovating, right? This charging technology has improved, from the first generation to its current generation. And if you're not investing in the latest technology and your competitors are, you're going to be left behind. And the leading player in this industry, Tesla, it also announced big cuts in this category, but still Tesla's way ahead in this technology, and others like ChargePoint trying to make inroads are finding it difficult. So one of the things ChargePoint is noticing is inventory is increasing as they're having a harder time selling. They're creating these products, these charging stations, but buyers are limited. Between January and April 30th, their inventories increased from 198 million up to 223 million. This is especially bad news for a company like ChargePoint that's in desperate need of cash. They need this inventory to turn into cash. They don't want it sitting around taking up space when it could be turned into cash, which they desperately need. They also have 284.68 million in debt, non-current long-term debt, and that's already weighing down on the balance sheet if they need to go out and borrow money, which they're likely going to need to do. That's going to come at much higher interest expense because lenders are going to notice the company's not in a good position. So if they're going to make a loan to this company, they're going to require very high interest rates, and that's going to make things even harder for ChargePoint because now it's going to be weighed down by even more interest expense on an income statement that's already negative in terms of profitability. So it's just a negative spiraling situation for ChargePoint. You can see here cash flow from operations improved in the 3 months ended April 30th from negative 104 million in the same quarter last year down to negative 62.5 million in the same quarter this year. The main area of improvement was that the company spent less money on inventory, which is good, but that inventory is still piling up. I'd like to see this negative amount in inventory reversed to be positive instead of negative. Why are they still spending money on inventory when they have a hard time selling their existing inventory? And the likely reason for this is because they've already contracted for those shipments. They've already ordered those shipments. It's already in the agreement. And if they were to cancel it, they would probably have to pay to cancel that agreement. So they just said it's better to just take the inventory and then we can try and sell it at discounted prices eventually instead of paying to cancel the inventory shipment overall. Regardless, it's not in a good position to be in right now for ChargePoint. Now, if you look at the company's operating profit margin over the trailing 12 months, it's just getting worse, negative 90.39%, and it's heading in the wrong direction, right? For a moment there, it was getting better, but then things reversed course and now it's getting worse again for ChargePoint. If you look at its cash flow from operations to sales, that did improve in the latest quarter as we saw, so it's negative 59.39%. But this isn't a long-running improvement. This is just temporary improvements from reducing the inventory shipments inbound. There's only so much more they could do there before they need to actually improve the business for it to generate organic cash flow from operations, which it's unlikely to do. As I shared with you, its cash flow from operations statement. The main improvement here, it improved by 42 million year over year. The main improvement was the roughly 29 million improvement in reduction of inventory shipments. So if you look at the top half of the balance sheet, or the top half, I should say, of the cash flow from operations statement, the bulk of this has remained the same. It's here in the working capital accounts that improvements were made, and these are only temporary improvements. You can't make sustainable increases in your cash flow from operations from your working capital accounts like inventory. You can only reduce your inventory to a certain degree before you can't make any more improvements in that category, right? You could cut your inventory to zero, right? You can order zero inventory and then you can sell all of your existing inventory, and that's the extent of the improvements you can make with your inventory cash balance or your inventory cash generation. So longer term, it's got to be the top part of the equation here. The net loss especially has to reverse course for the company to make progress there. Finally, it's trading at a forward price to sales of 1.1, which is down significantly off its highs, but it's still too expensive in my opinion. This stock needs to be trading at a fraction of this valuation in order for me to feel like it's worth taking a chance on for the longer term if it can get things right and put itself on sustainable footing and then capitalize on perhaps another significant government stimulus or government incentive that encourages installation of charging stations, some positive event happening for the company. Right now at current valuations, I think the risk versus reward is not favorable at all, and so I'm avoiding ChargePoint stock here at current valuations. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.